Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Hi, welcome to FRA's Roundtable Insight. Today is August 12th. This is Richard Bernoulli. Today we have Tian Yang and Ira Harris. Tian is with Variant Perceptions, boutique firm specialized on independent investment research and asset allocation. Ira is a hedge fund manager, global trader in foreign currencies, bonds, commodities, and equities for over 40 years. He has served as CME director from 1997 to 2003 and also a stint most recently. Welcome, gentlemen.
Glad to be with you.
Yes, thank you, Richard, and Tian, another pleasure. Thank you for having me.
Great. Let's begin with a discussion on the economy and financial markets, your global macro view, if you'd like to provide some insight into that, Tian.
Yeah, sure. So at Variant Perception, our approach is very much focused around leading indicators of growth and liquidity. So mostly we try and identify what are indicators that have been proven to have turning points ahead of coincident data like GDP, and really just follow those and look for where the turns are. So as of today, really what we're seeing is that liquidity conditions have already been tightening for a few months and look to be continuing to tighten. So things like excess liquidity have really shrunk a lot. Basically, money growth is slowing whilst the economy is doing well and whilst inflation is picking up. So it's kind of absorbing the kind of liquidity that was out there that was helping to support asset prices. So that's probably quite a notable change at the moment. On the growth side, lead indicators have actually been quite strong, but they're no longer going up. So it's very much going sideways. So, it kind of suggests the economy is still going to do well, but it's probably not going to surprise people on the upside. So I think in a nutshell, growth is set to be good, but liquidity is tightening. And so to the extent that, investors and assets are going to trade more on the second derivative moves rather than the first derivative moves, then obviously the environment's kind of, for the next few months does look a bit trickier at present. So that's probably where we are in a nutshell. In terms of regions, the US has been by far the most aggressive in terms of easing policy. So naturally the US economy is doing kind of relatively better than the rest of DM and EM as well. So that's a pattern that still looks set to continue, where most central banks are now, especially in emerging markets as well, obviously shifting to much more of a tightening mode. And obviously in the US, the Fed looks set to still, go very slow. Maybe they take or maybe they won't, but it's obviously going to be much, much slower than everyone else. Great, interesting. And your thoughts, Ira?
Well, I'm just watching the global system and focusing in on the removal of some of the stimulus and comments that emanate from the cacophony of voices, all who are part of the central banking establishment, and seeing how they're planning to, or if in fact they are planning to exit from this very aggressive monetary ease that they put into place, to offset the most dire mal effects of the pandemic. So that's what I'm watching. Fiscal policy is, of course, very important, but monetary policy, which every time they talk about pulling it back and equity markets and other asset markets react in anticipation of it, central banks, especially the developed central banks, certainly not the emerging markets, because we've seen absolutely antithetical actions from them, but they get cold feet and then reassert, especially the quantitative easing programs, or better phrase is asset purchase programs. So this is what I'm watching, as is the rest of the world, trying to figure out how this is all going to unfold. So,
And Tian, what asset allocation models and generic asset classes does your firm emphasize in this environment? What are you guys looking at?
So as I mentioned earlier, it's a somewhat of a tricky environment. We were phrasing it as very much, we're into phase two of an equity bull market. So, in a very stylized way, if you think about broadly, you can break it down into three phases. So phase one of the equity bull market is when there's generally widespread skepticism on the rally. So typically, equities are going up because valuations are going up. The economy looks to be in recession and people are very bearish. And so that's kind of phase one, and that's kind of when the easy money is made. Phase two is when it's kind of what we're in now, where you have that initial rally, valuations have surged, and now earnings growth has to come through to justify the previous surge in valuations. And so typically and historically, this ends up being a pretty volatile sideways market for about a year. With obviously you get rallies and corrections within it, but no real trend in the market. And arguably for the past few months, we've kind of been seeing a lot of rolling corrections across various sectors in equity markets as well. So broadly, we're kind of somewhat more neutral on equities if you're going to be in terms of taking outright risk. However, obviously, if you look at equities relative to bonds, in terms of most asset allocation model, with the bond rally, it's starting to on our models look pretty expensive, especially if you consider that we're only about a year or year and a half into the new economic cycle. If the average growth cycle lasts 6 or 7 years, it doesn't it is quite strange for us so early in the cycle for the yield curve to really want to flatten. And then and so yeah, broadly speaking, I think we cautious optimism on equities, but it's not really the nicest environment. I think a lot of the kind of big moves have kind of happened already, so we're kind of waiting to digest the earnings growth, waiting to let a lot of the kind of fallout from the fading second derivative of previous stimulus kind of work its way through right now. So yeah, I would frame it as if you're kind of forced to hold equities because there's not much else, but we wouldn't be it's about just actually being slightly more defensive, focused on quality, because within equities you're kind of forced to hold equities.
Mm-hmm. And I understand you have a strong focus on commodities. Can you speak to that asset class? Which ones are you bullish on? Which ones are you bearish on?
So I mean, variant perception, like the approach is just very much about being data driven, using lead indicators to try and highlight investment themes. So commodities is kind of a major theme for us at the moment. In the back of a couple of indicators that came together last year. So in addition to obviously all the usual cyclical recovery indicators and that everyone's kind of been talking about, commodities obviously coming from like a multi-year period of underperformance, and you basically had a massive drying of capital flowing into the sector. So we have a lot of capital returns, capital cycle models that essentially tries to track the flow of capital into and out of different industries. And so what we've been seeing is that in general, most commodities, especially traditional, the dirtier commodities, have seen obviously a huge outflow of capital. Investor interests have obviously massively died down. And so you end up with most of these sectors being extremely capital constrained. So that just means producers don't have the money to spend on capex. They don't have the money to explore. They don't have the money to expand production. And so, if supply is very tight and shrink and obviously diminishing over time, and demand picks back up, then obviously, that's the recipe for kind of a sustained period of elevated commodity prices. So that's basically the kind of, the three, when we put it together last year, this is kind of the 3 to 5 year outlook right now. And in particular, the areas we highlighted, things like oil and gas, things like copper, where, supply constraint is very, very strong. But where we think, you're going to see a quite quick normalization of demand, as the economies reopen, as vaccines get rolled out. In particular, if you look at a lot of the news around within the oil and gas, especially the majors, right, you get all these shareholder revolts against them. The ESG revolts against them, expanding kind of production or exploration. You're going to end up with a situation where there's very few producers, and supply is just completely constrained. And so then, the potential for kind of really big moves in oil prices upward, it becomes a lot more likely. So those are kind of more the areas that structurally we are still pretty happy with. But as I mentioned, over the next 3 to 6 months, it is a little bit tricky because obviously if things have come up such a long way already, and a lot of the cyclical tailwinds are kind of diminishing, but the structural picture remains very, very bullish for those. So that's kind of where we stand with that today.
Interesting. And your thoughts, Ira?
Well, let me. It was interesting that Tian talked about on the yield curve, because the yield curve is. Can they flatten in this environment? This is a big question for me, because yield curves have historically, on my work, and I've been trading for 44 years in a global macro setting. And looking at these things, flattening yield curves have usually signaled, of course, coming recessions and equity market declines, and basically a sell-off in all types of assets, because central banks were moving to be tighter in an effort either to slow an economy for fear of inflation, or that they were trying to they were behind the proverbial curve, and then overreacting. The markets got a little nervous. In today's world, I don't know what they mean, because the central bank intervention into breaking and corrupting the signaling mechanisms result in far different outcomes. Classic is the United States. You see movements based on, of course, the algo headline readers, which drive, hour to hour, so to speak. But if the Fed moves its purchases further out on the curve in an effort to contain long rates from rising, and the curve flattens for that way while you're getting massive fiscal stimulus, I don't know what this means. But where I would inherently then be selling off, and I've been and remain commodity bullish for the moment until I see more, because I think the fiscal stimulus as monetary stimulus was contagious around the world. I think fiscal stimulus will be ever more contagious in a rush to whether it's to cover infrastructure projects or other things. I think that they'll all follow the U.S. down this path, by the way. So where rates should be going higher, but they don't. So how do I treat the commodity markets? And again, I think I remain bullish, and I'll continue to be bullish even more than watching the yield curve at this moment, as long as the dollar really doesn't have a rally here. And when I'm talking about that, a 10% rally, I think that commodity prices will continue to be sustained globally. So that's the way I'm seeing it. But based on, there's a lot of factors here that are truly up in the air. I'm trying to, as the Fed has never walked down this path, and other central banks. So now we have to try to understand how this is all going to be, if there's ever an exit strategy.
Yeah, no, that's such a great point on the yield curve, right? Like, I think we've one potential historical analog is the Fed Treasury core period, so 1942 to 1951, where that was kind of the last time where there's a lot of analogies where back then obviously it's World War II, this time it's the pandemic, where governments can make a case that morally they have to spend a lot of money, and the central bank has a role to play to help cap yields. So that's kind of analogies to that period, but ultimately that ended up with not only very high inflation, but very volatile inflation as well. And so there's definitely hints of those things, hints of kind of monetary policy, fiscal policy kind of coordination, and fiscal dominance are present. And so when you see this, then obviously the natural response is that even if inflation is immediate, the risk of more elevated inflation should be going up, or at least that's what markets should be pricing. And yet, obviously, what we've seen is quite a different reaction from fixed income markets versus everything else, right? Obviously, commodities going up generally reflective inflation. We've built kind of inflation factors using equity market prices and equity sectors. And again, they're kind of more consistent with kind of very, the 4 or 5% kind of inflation prints we're seeing. And yet, obviously, what we see is, 10-year yields down, 130 or term premium back to zero. So yeah, for sure that there's quite a big divergence there. But it seems more that the fixed income is kind of the odd one out for now. So yeah, it is a tricky situation. And partly, if the Fed starts owning 50-60% of the issues at some of the longer end, eventually, then obviously that's going to inevitably have a distorting impact on the curve. So yeah, it is a tricky one, but it does seem like maybe the information content in fixed income prices are kind of a bit less than before.
Yeah, Tian, it never ceases to amaze me when they do bring out the different speakers, whether from the ECB board or certainly the FOMC, and they all talk about, low bond prices, low bond yields, and and yet they never point the finger. Let me say, I won't say never, but so seldom do they point the finger at themselves as to why prices are. It'd be like the BOJ saying, well, bond prices are 10-year JGB prices are at zero. I wonder why. Well, you own 60% of the outstanding JGB, but they don't, because they fail to want to understand the way really markets react. And everybody, tongue in cheek, that great phrase, the bond vigilantes. But just like in Japan, when in the 90s, late 90s and early aughts, when everybody said, well, the Japanese deficit is it's out of control, I'm going to sell the JGBs. Well, that didn't work out, so they famously called it the Widowmaker. But it is where I would like to show up to get short the long end of the curve. I've learned I can do that as a trade on any given day, but to put it on as a meaningful position with time behind it is that's like, I may as well just keep beating my head into the wall, and they won't accept their responsibility. And as I remind people, look at one of the big aspects of the bond vigilantes that shows up is the fact that people who have duration risk come to the market to hedge. Whether you have convexity risk, and you're a hedger. The Fed, which now I believe the balance sheet is how big are we at now? 8 trillion.
Yeah,
I think
and growing. Yeah.
And growing. They don't hedge because when you own a printing press, you don't need to hedge. It's the dream of all of us. I would love to. I'll show you what positions I could put on if I had a printing press and could just put the money back in my account at the end of the day. So they're missing from the game. And the more they take of the market by design, the less selling there's going to be, because there are no natural, you're removing a huge natural seller from the marketplace.
Yeah, I mean, it's almost a bit, I think discussions around the Fed often takes kind of two paths, isn't it? It's like one thing about what they should be doing, but then there's the other thing is what they will be doing. And obviously with the rise of MMT and all these things, a lot of the intellectual groundwork's almost being laid to kind of justify the forever easing kind of policy we're in. And if anything, if you look at the pandemic coming out of it, policymakers will probably think that they've done very well, right? Before the pandemic, who would have thought you can pump this much stimulus in and not break something? But right now, obviously, it doesn't look like anything's broken. So policymakers will think, oh, that worked. We haven't really hit the limits yet. We should keep doing this. Maybe MMT is right. And so it does seem like we are kind of, the box, the Pandora's box has been opened, as you say. The US has done it. It looks like they've gone away with it. So now everybody else might look at the US and then try to do that, and we end up with this kind of fiscal dominance everywhere. It does seem the way it's going. Like there isn't like a Volcker character to anyone showing up anytime soon, it seems.
Well, imagine, and that's the conundrum that they place all investors in, and it's certainly large institutional investors, because if that, as you say, Volcker figure were to show up, just think what it would do to the portfolios of all these people, because there's no way that equity prices could be sustained, not a chance whatsoever. And it would bring down hell on earth, especially because if that was the case, and I don't believe it can happen because of the vast amount of dollar-denominated debt, and not just public sector. If I go back to the 70s and 80s, when we ran into the third world loan problem, as we called it back then, I was in back in the less developed nation, whatever we want to call them, which was plagued from the OPEC crisis with massive debt overhangs. This dollar debt crisis it's not here yet, but what will make it so much worse is that even in the private sectors in the emerging markets, the massive dollar debt really is, I think, is a huge problem that's going to impact and will continue to impact Fed policy. Because how do you raise rates? How does the United States be the first one out the gate of the developed world raising interest rates, watching the dollar rise and everything that it brings down upon it? The Fed's going to bring into fruition everything that says that it's trying to keep from happening. But I think that's how critical the dollar is, and we see that mirrored. And I talked about this yesterday with Russell Napier, but we see that mirrored with what happened in Switzerland when the Swiss had, said, well, we're going to maintain the peg of the Euro Swiss at 120. And so everybody in Eastern Europe was borrowing in Swiss francs for mortgages and everything else because interest rates were so low, and you had a stable currency until the day they pulled the peg when they had to, because they couldn't sustain it anymore. Even the Swiss couldn't sustain it, not in the way that they were doing it. So you had a phenomenal retrenchment of growth in Eastern Europe because all these people were borrowing in Swiss, and now they were truly underwater because the Swiss had appreciated so much that these cheap loans were no longer cheap. I'm afraid in my mind, that's where the dollar sits right now.
And Tian, do you look at trends in the fundamentals as well in your research? What are your thoughts, for example, on stockpiling that by Asian countries, let's say China? What do you see about that in terms of trends in the fundamentals?
Yeah, I mean, obviously, in terms of our research framework, we do start off being quite top down. Obviously looking at growth, liquidity, but we try and do a lot of bottom up as well. Actually, look at companies, read company transcripts just to give us some context and to see if themes do form kind of in a bottom up way. So those things we do kind of put together, try to put together. So, but I guess. Are you more referring to commodities stockpiling or what? Yeah. Okay. So I think obviously what we're seeing is like a huge amount of a huge pickup in Chinese imports, right? Pretty much every kind of commodity under the sun for a while, and I'm sure that's contributed to kind of the very rapid rise in prices. So obviously a few months back they've come out and announced that they're going to start releasing commodities from their strategic reserves to try and just put a lid on some of the price rises for now. But these are probably more temporary things. Like ultimately they will need to restock, right, and refill those reserves. And ultimately we're moving to a world where there will be a lot more fiscal spending, infrastructure spending, right? Obviously, a lot of it linked to green energy. Obviously, if you're going to build out anything green energy, you need a lot of traditional minerals and metals and the like as well. So, ultimately, I think China is just trying to let the market cool down a little bit, but they're going to be, they'll need to go back in at some point. And it's almost, you can view as like kind of, if we are going to this new Cold War, between US and China, like it is an arms race, right? It's an arms race in the newer technologies, right? In like electrification and renewables, all these things, right? So, all commodities are an increasingly important strategic resource. So yeah, I think the trend is very much set that they are going to be building, they're going to be using, they're going to need more. It's just right now we're seeing a temporary blip where, because of the announcement, you kind of had, now that, when it came out, announced they were releasing reserves, obviously prices had a little bit of reaction, but I wouldn't think that's kind of any kind of sustained reason to be bearish, right? Ultimately, they'll need to buy it back.
And your thoughts, Ira?
Well, I love this conversation because, and I believe that, I believed it last year when Louis Gavay were on with you, Richard. We were on a couple of times, but certainly in May of 2020, that was going to be a possibility, because once you get a depreciating dollar, and the Fed had done so much between the swap lines and cutting interest rates to zero in the first legs of the response to the massive slowdown from COVID, that if I was running the People's Bank of China and the NDRC, I would have been stockpiling, because I had all these dollars that I need to do something with. And when do nation state actors like China or others, Russia, when do they take what they view as certainly a high probability of depreciating, meaning the dollar at that time, as a response? Why wouldn't I be buying real assets that I'm going to need anyway? From soybeans to corn to steel to iron ore to copper to, but I don't just have to buy precious metals, but it's no different than wealthy people buying apartments and Ferraris and Picassos. I need assets, and if they're assets that I'm going to use and I can actually warehouse, like Joseph in Egypt, why shouldn't I be buying them? So I think we saw massive amounts, and it made sense, especially with the Yuan spent until recently. I mean, we had a sizable move, I think, from about 7.1 Yuan to the dollar down to 6.4. So a strengthening Yuan on top of it made all of those Chinese imports of materials that much cheaper. So they've benefited from it all. And lo and behold, the interesting thing is, of course, we've seen two auctions by is the NDRC, I think that's what it is, national, where they've sold some of the stockpiles that certain people, I argued, no, the Chinese aren't stockpiling. Well, they certainly were stockpiling, and they sold it off to ensure that Chinese producers and Chinese producer manufacturers had enough without driving prices higher. So I think the Chinese have played this phenomenally well, and I think that there's still going to be a natural buyer. Everybody talks about bottlenecks, right? Supply bottlenecks, and I agree in certain ways, but the outlier is, of course, food prices. We've had record harvests around the world in grains, from wheat to soybeans, and yet food prices raced up, which to me, that was to tell that the Chinese, because who else could buy and stockpile that much, and who would need it, was the Chinese. So they drove prices up dramatically, even in the face of massive supply. And until that changes, I think that's the overall strategy. And why not? Why wouldn't you? To me, it makes perfect sense.
And Tian, what are your thoughts on the Chinese currency yuan and effects thereof on commodity prices? Do you see linkages, and what are the trends in that regard?
Well, I mean, just like we're talking a little bit earlier about, the yield curve and central banks manipulating it. Obviously, in China, ultimately the RMB is a targeted rate, right? Like, they're going to decide where they want to set it, and it's actually more a reflection of policy making. So, to the extent it moves, it's more trying to, you're trying to interpret what that means for what Chinese policymakers think about liquidity conditions domestically, right, and where they want to ease it or not. So that's probably more the framework I look at it in, rather than try and read too much into it, giving other reads. So I think for commodities, generally speaking, I'm looking more at what's global liquidity in terms of cyclically. Cyclically would be global liquidity conditions. What's Chinese growth doing, and then looking at what the supply response is, right? So in terms of obviously you can build diffusion indices across a lot of different commodity sectors. What is the growth in supply, and how quick has it been? So those are kind of the more key cyclical inputs. And then in terms of strategically, or if you want to talk 3+ years out, then obviously, as I mentioned, the capital cycle is extremely important when you're forecasting these kind of longer term time horizons. And right now, we still think it's a lot of signs of capital scarcity. Obviously, not as bad as before, but still, still signs of it. So, broadly speaking, I think the bullish trend remains very much intact, and and potentially, if you like, a third kind of source of demand that could really kick in is this idea that focus on real assets for kind of that, for Western investors, right, or for actual financial institutions, right? If there's genuinely more concerns around inflation, or more concerns around just the lack of yield available, and you get investors start to shifting back into commodities, then there's potentially a huge wall of money to come in that can really drive it up. Obviously, we've seen lots of commodity specialists, commodity funds kind of close down over the years, right? Since the kind of the 07, 08 peak in commodities, everything kind of around the sector is just been shutting down. So, if these things start to reverse, then obviously that's a whole other source of demand that comes back. So, I think structurally there's still a lot of things in play. So the mindset is always very much about, trying to buy dips, trying to just ensure that the valuation is at least fair if you go into the equity space related to commodities. So, I think if I look at China, it's mainly about Chinese growth I'm concerned about. And we've not found a very obvious correlation between the RMB and commodity prices once you account for those factors like global liquidity, Chinese growth, and so forth.
Mm-hmm. And your thoughts, Ira?
Oh, that's why we have these discussions, because I've been sitting here watching it, and the correlation with RMB strengthening and the beginning rally in food prices, global food ag prices, to me was very telling. But again, there's a lot to be seen here, and people, we've heard nonsense. Well, I call it nonsense. Other people tell me I'm nuts, but punch protection teams and all types of actors. But there are massive nation-state actors, and when they get involved in the markets, just not the Chinese. Again, the Russian sovereign wealth fund, the Saudi Arabian investment fund, the Kuwaiti investment fund, the Norwegian sovereign wealth fund. We just saw the numbers at the end of mid-July from the government pension investment fund from Japan, which is probably the largest of them all. And I'm not even counting Norchukin. There are so many large actors that if they start playing, just like central banks play in the bond market and run the bond market, what about these other nation state actors getting involved in these markets and really running them? And I'm not sure we're not seeing some of it now, by the way, because huge players can push markets and just trade it and find a way to generate, as the Wonks would say, a little extra beta on their portfolios. So I'm just looking for this to become much more of the rubric of global finance. I've been around long enough that I saw back in the 80s and early 90s with the Monetary Authority of Singapore, and being that I am probably 60% of my views emanate from my foreign currency trading. But this is going to be interesting to me, because now with all this liquidity and using, that Tian talks about, and it's certainly out there, there are many, many reasons for these large actors to become actively involved in a lot of these markets. And then we'll really see some interesting movements.
What are your thoughts, Tian, on precious metals? And do you see any major currencies being backed by silver or gold in the future?
So I think the structural case for gold is obviously been clear and has been obviously throughout the past few years, right? Ultimately, there's a lot of money being created. The amount of physical gold is limited, and obviously you can work out what's the amount of nominal money in the world divided by the stock of gold. And obviously we're not producing a lot of gold, so obviously that's going up. So the fair value of gold is being dragged higher. But obviously we know that gold tends to be, there's a lot of hot money inflows and a lot of speculative flows around it. So the point we made is that ultimately, yes, it's a good long-term allocation, but it's also important to be aware of how brutal the moves can be. Even during the 70s bull market, you had a few big crashes in there as well. And actually, historically, whenever real yields went too negative, like say back in the 70s, that actually coincided with the start of the crashes. So I think it's something that ultimately we would be looking at trying to buy dips on. Obviously, it fits in the real asset bucket, it fits in the kind of hedging a portfolio, right? All these things buckets, but it's more just, it's not straightforward. Just be like, okay, there's inflation coming, or rates too low, so it makes sense for gold. So so I think we actually luckily sidestepped a lot of the recent move where we actually turned away from being bullish a few months back on gold, just because a lot of these cyclical factors just show gold getting too extreme, where investors just got too bullish on it. And so even though the macro environment stays good, it often has these huge crashes. So what's interesting right now about just even the past week, when you start to have this big gap down in gold, is this gap down was happening when the trend intensity score was very low. So we can look at trend intensity by essentially it's a calculation essentially of how close together all the moving averages for that particular asset price is. So say if you take 200-day, 100-day, 50-day, 40, 30, 20, whatever, right? And basically essentially when all the moving averages stack on top of each other, it just tells you that obviously it's kind of lacking trend recently. And typically in those situations, a lot of stop losses would have built either side, because there would have been a ton of trading at kind of at current prices essentially. And so when you break out from those things, there's a tendency to trigger a lot of stop losses. So the fact that we broke out to the downside of gold, it might not be over yet. So we're kind of waiting to see that play out. We're waiting to see our trend intensity scores kind of on gold normalize a bit, and then we'll probably take another look at it. But the bias would be to try and go long. But a lot of these the kind of trading dynamics around it make me it's not super clear at the moment.
Great. And Ira, your thoughts?
I'm exactly with them. And in fact, I traded it on Sunday night because that was a big area that we came down to. Interesting when it took place, but I think the algos in today's world drive things in ways that an old person like me has to readjust to. But that 1675, 1680 area was an area I was waiting for. So it was a good opportunity for me, but it's only a trade right now. It's that, to me, gold is not an investment at this moment in time. I mean, you can buy some, I think, gold stocks of high quality ones. They may have a dividend, so you can but I wouldn't buy it on any rally. I think that the market's trying to calculate its way through here. And really more important, I think we're not quite seeing the same thing yet, but if we go back to 2011, 12, and certainly, let's use 2013, when gold was up at 1650, 1660 after and it was kind of struggling there. I know it's hard to say struggling, but the equity markets, I think the S&Ps were at 1,100, 1,200. You could see that the world was becoming more comfortable, that the central banks had weathered the storms. We saw the ECB with Draghi, whatever it takes, the BOJ, and certainly the Bernanke Fed, that people said, gold has kind of run its course here. It doesn't pay me anything to own it. I think the initial storm has passed, and equities may be a better investment. We're not seeing that quite as dynamically here. Gold is going sideways, but I think it has been a tired bull market. And I think that's what Tian was talking about with some of the momentum, studies. It's tired, but I'm amazed that it still holds up here. Yes, we're $300, or we were off its highs of not long ago, but it's held up in there. In fact, it's interesting that it's holding. That's why that area was important for me, because we go back to 2013, and where that was the top, this now may become the floor. So I want to watch it, because there's a lot of reasons, because as Jan really talks about, when real yields, and most people don't realize, but the real yield on 10-year U.S. government debt over a 40-year average is almost 2.5%. The real yield. Well, right now, everybody sends me those charts every day. So right now we're on 10-year. We're probably, I think the last I saw was negative 110 basis points. So gold has a lot going for it based on that, but I just believe it's a tired bull, and there's other areas where people have branched out to able to make money, and it may be some of the other commodities too, as we've seen over the years. And some will argue the cryptocurrencies, but I'm not going to make that argument, because I'm just not smart enough to see that. So, but I agree with you. It's a trade. It's not an investment here.
And just a final question, Tian, in terms of your investment and trading methodology or approach, how do you use like futures contracts, physical holdings, and commodity firms, commodity businesses? What makes sense at what time?
Well, we look across all asset classifiers, so we don't just do commodities. It's just recently, because of the opportunity set here, we've been very focused. In general, we kind of take two approaches. One is in the top down. In the top down way, we obviously is a more kind of we look to utilize options a lot. So look at different ways of structuring trades using options when it makes sense to kind of adjust the risk reward to kind of reflect our views, right? So for example, if we think yields should go higher, but there's a lot of concerns, it might make a lot more sense to express that using options and take advantage of the fact fixed income volatility is relatively cheap, because obviously nobody believes the Fed will allow it to move higher. So there's things to be done around it. But otherwise, the second thing we do is, as I mentioned, we're trying to think of ourselves and try to do like 50% top down, 50% bottom up. So often we'll try and look for kind of bottom up equity expressions for a lot of macro themes, because those are often give you kind of multiple layers of margin of safety, if you like, right? You can, hopefully be more right than wrong on the macro, but on the stock level, you can find good management teams, buy at a good valuation, give you that margin of safety. So, so I think that's where we try and spend a lot of our time to try and translate things down to single stocks. So that's probably more kind of the default way we do it. So, one approach is thinking a lot about using options to structure trades, and the second is trying to find just equity expressions for a lot of macro themes.
Interesting. And Ira?
I wish I was more adept at the options. I use them to at certain times, but I predominantly trade futures, and I trade a lot of. I'm like Ian in that when I see a view like last year, Richard, and we were very vocal in several podcasts with several people that I did with you, that take a top-down analysis. And what did it lead us to? It led us to buying certain mining stocks, and we only talked about certain ones like Freeport. When it was down at it, we were very. I remember with Louis Gavet, we were and with Mark Fowler, we had talked about on your podcast certain companies that really panned out well because they were so unloved. And yet there was all this liquidity that was being pumped into the system to prevent a mass liquidation of assets. So, and as the market, they didn't really jump on anybody's radar screen because everybody was looking at a deflationary possibility. So I trade stocks. Those are much more of an investment. I invest in stocks, I should say, when I see views like that, although I'm never opposed to taking a profit. As somebody reminds me, I've existed this long because I always took profits too early. But I will take a top-down view and try to apply it. So those became, very good trades. But for my most daily, weekly, monthly trading, I trade in the futures markets because that's where I was raised. It's where I'm comfortable. And they're not for everybody, of course, because there's a lot of leverage involved. And as we saw following back in June, when the Fed supposedly turned hawkish on June 16th, we saw the Bloomberg Commodity Index for the next 8 or 9 days get pummeled as a lot of people who were overly leveraged in a lot of the commodity areas and in the equity areas everybody ran for the exits at the same time that the airwaves were filled with the end of the reflation story, which I think I may have been on with you at the end of the month and talk about, I think that's nonsense. What you're seeing is leverage is a wonderful thing when the market is going your way. It's the worst poison in the world when it turns against you. So that's what we saw. But so you have to know how to maneuver yourself in that environment. It's not for everybody.
Mm-hmm. Great. And in terms of how can our listeners learn more about your work, Tian?
So the easiest is probably go on variantperception.com to have a look at our company. Obviously, we maintain a blog there. We are an independent research provider for institutional investors. So, a range of clients, hedge funds, asset managers, family offices. We're essentially trying to serve as almost an outsourced CIO kind of role and just provide good investment themes.
Yep. And Ira?
You can find me doing these. You can find me in White Wave. You can find me in the PAX, Matt Kenna's trading room quite a bit, just discussing things. And of course, when I do write Notes from Underground, which is my blog where it's not what I write, it's so much of the response that comes in. And there's a very wide global readership, and the discussions are kept to a very high level with no politics. If you bring politics in, it's your poison, and we shut it down. We'll talk about policy, not politics, and I try to give an overall, on a regular basis, of the global macro situation with political analysis. Because at the end of the day, I am was trained and educated in political economy, not just as an economist, and I think it's done me very well over the 44 years I've been actively trading and investing.
Great. Well, it's been an interesting and insightful discussion. Thank you so much, gentlemen. Thank you, Tian and Ira.
Thanks, Tian. I appreciate it. Thanks, Richard, for the opportunity.
Yes, thank you both. Thanks for having me.
Yeah, this was really, really good. I'm glad I had an opportunity. And now I'm going to go to your website.
Okay.
All right. Thank you.
Okay, guys. Yeah. Bye-bye.
All right. Cheers. Bye-bye.
The FRA Roundtable Insight Show is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.